Good morning, Dr. Sabarina and my friends. Today we are going to present about inventory case. We are from Group 4. My name is Shankari Mutraja and my metric number is 196682. This is the specific case assigned to our group, which is about near, Fine Jewelers Incorporation. The process involved in this case is inventory management. Inventory management is a part of supply chain management and is very important because it controls all process concerns from the time an object reaches the shop before it's dispatched, and usually its method for managing, processing, and monitoring the item store typically includes activities such as order management, warehousing, and packaging and delivery. In this case, we can see that Fine Jewelers Incorporation maintains a diamond wholesale store in New York City. There are seven documents involved in this case. Firstly, purchase requisition form. Purchase requisition form usually consists of date of requisition, stock code, quantity needed, supplier, supply product code, and so on. And second, purchase order. Purchase order consists of company name, address, and contact details, purchase order, date, and suppliers' names and address. Actually, at least two copies of the order will be available, one for supplier and one for stores. These are the example of actual delivery note and good receipt note. And then purchase invoices. Purchase invoices is the evidence of payment due shall be obtained from manufacturer and until clearance for credit to the supplier account and corresponding payment. Next, material requisition form involved when supplies are needed to manufacture. And then production order. Uh, Production order may use issued setting out the goods and labor needed to produce the goods or orders by customers. These are the number of inventory journal entries can be used in inventory transaction. First transaction would be inventory purchase. The entry is uh, debit raw material inventory, debit merchandise inventory, and credit account payable. Second, indirect production cost in overhead. Basically, there are many forms of cost relevant to output that are assigned to the inventory, such as leasing, electricity, and so on. The entry is the debit overhead cost pool and credit account payable. And then record production labor in overhead. Typically, the application for this changeable of the salary value into cost databases. The entry will be debit overhead cost pool and credit wages expenses. Move raw material to work in process, debit work in process inventory and credit inventory, raw materials inventory. And then record inventory scrap spoilages. Usually certain volumes of scrap and spoilages may naturally occur during the of manufacturing. The entry is former situation is debit overhead cost pool and credit work in process inventory. For record finished goods, debit finished goods inventory, credit work in process inventory. For allocate overhead transaction, debit work in process inventory, finished goods inventory, cost of goods sold, and credit overhead cost pool. Sale transaction entry happens if items have been delivered as manufactured products. So the entry will be debit cost of goods sold expenses, credit finished goods inventory. Ob- Obsolete inventory entry will be debit cost of goods sold expenses, credit obsolescence reserve. Then last, logo of cost or market entry. This entry involved when a company decided to reduce the carrying price. So the entry will be debit loss on inventory valuation, credit raw materials inventory, work in process inventory, and finished goods inventory. Okay, that's all from me. Nadia will explain further about this case.
For the flowchart in inventory, it starts when the entity purchase raw materials and then bring to the warehouse. Uh, and then the inventory will go to production and quality checks. And then the inventory will be distributed to other retail store. The internal control is plan and perform test of control. The auditor needs to identify the relevant control activities of all the inventory in the entity to prevent misstatements. For example, uh, misstatement of counting. And then the auditor also needs to discuss the audit procedures occurred. The second one is set and document the control risk. That is, the auditor needs to set the level of control risk. The auditor also needs to document the achieved level of control risk using either quantitative amounts or qualitative terms. For risk area, inherent risk, engagement and operating characteristic, the first one is the type of product sold can lead to bankruptcy. For example, fine jewelry incorporated having inventory that is diamond. So diamond is very small and valuable. So it's easy to be stolen rather than large inventory. Second is inventory is often difficult to audit because of there's so many inventory need to be counted. Finally, the auditor must be alert all the time. For control risk, high level of control if the auditor adopts a substantive strategy when audit. A substantive strategy is strategy that do not rely on the entity's control. It may be appropriate when internal control is not adequate. For fine jewelry incorporated, it not advisable to using substantive strategy because for fine jewelry incorporated needs to rely on the entity control. For the assertion, the first one is occurrence, where the inventory transferred to inventory department using categorized materials requisitioned. The second one is completeness, is the consigned goods are properly accounted for procedures to include goods out in on consignment and remove goods held on consignment. The third one is accuracy. The inventory and cost of goods sold are properly cost based on standard costs that are reviewed by management. For example, in the case of fine jewelry incorporated, the management immediately know how to value a customer order. You can take a look at the case. Cut off. All the inventory transactions are recorded in the right period. And the fifth one is classification, where all the inventory transactions are properly classified. For procedure, the first one is inspection of records or documents, which the auditor examining internal or external records or documents that are in paper form, electronic or other media. The second one is inspection of tangible asset, which means a physical examination of asset. In this situation, it will physical examination of the inventory. The third one is observation, where the management needs to looking at the process or procedure being performed by others in the wholesale, where the inventory is kept. The fourth one is external confirmation, where the audit evidence obtained by the auditor as a direct written response to the auditor form from a third party that is confirming party in paper form, electronic or other media. For example, when a buyer come to the store and buy their finished goods, the receipts occurred or invoice occurred between two parties, between to the third parties, will consider as audit of evidence. And that's all from me. Let's move to the next point.
Thank you, Nadia. So I will continue the definition of one from of which we participate, writing on the physical dimension and risk of the presentation of the identities, being of event if the of the only control make sure that the value and from the and the real for they will and from one city to another. How is the objective have everything uh, sellers and listeners that insist that our deals are inevitable, achievable, offering on good guidance on quite valuable as so important in of so yeah, how so chances so even fast for its
Okay, next, prior to the physical count of the inventory, the auditor should be familiar with the inventory locations, management process, and instruction for counting inventory during the observation of the physical inventory count. The auditor should do the following. First, no production is scheduled, no movement of goods during the inventory count. Following the inventory count instructions, inventory tags are issued sequentially to individual departments. For perform test counts and records a sample of counts in the working paper. Tag control information for testing the entity's inventory complication. Next is cut-off information. Observe the condition of the inventory for the items. Inquire about goods held on consignment for others or held on a bill and hold basis. Okay, next, question 3. Assume that a shipment of diamond rings was in transit by messenger from the wholesale store to a retail store on the inventory date. What additional audit steps would you take to satisfy yourself as to the gems that were in transit from the wholesale store on the inventory date? Okay, first, as an auditor, I will take as additional steps to perform the inventory valuation. Start off by utilizing the in-transit inventory management to ensure that it is measured and no duplication occurs in the physical inventory. Suggest the diamond transport in transit to happen in the presence and associate of the Certified Professional Accountant CPA company at the department store to avoid any frauds happening. Confirmation of usage of the diamonds in only one source, physical inventory, should be made along with the assurance of real products income being excluded from the sales to avoid major financial exploitation. Diamond specialists should be present to test the diamonds and jewels to know its reliability, authenticity, and condition, which caters to the special judgment with the shipping records. That's all from us. Thank you.